Dear viewers, compliments of the season from me, Louis Rossouw. May you and your loved ones enjoy a healthy, safe and prosperous 2022. In this presentation, I will not only just discuss the events of December, but I'll also review last year as a whole and share with you our views on the year ahead. On the international front, a surge in new COVID cases due to the emergence of the Omicron variant caused severe disruption. Travel bans were instituted, many flights cancelled, and lockdowns were reintroduced in many countries. The good news is that it seems as if the Omicron variant, whilst more contagious than its predecessors, is not as deadly. By year-end, more than 290 million people had tested positive for COVID-19 worldwide, and nearly 5.5 million people had succumbed to the disease. The United States remains hardest hit, with 56.2 million infections to date and nearly 850,000 deaths. India, Brazil, the United Kingdom, and Russia make up the rest of the top five, and South Africa remains in 18th position in terms of the most recorded cases. Experts have expressed hope that COVID is in the process of morphing from a pandemic into an endemic disease. America, Britain, and Pan-Europe experienced the worst increases in new cases during December. It is now a common cause that vaccination protects us against serious disease and death, but does not prevent spreading of COVID. To date, nearly 59% of the world's population has received at least one dose of vaccine, and nearly 49% can now be regarded as fully vaccinated. The uptake in low-income countries remains disappointing, but vaccination rates are fortunately on the rise. The new practice of administering a so-called booster dose of vaccine to people previously regarded as fully vaccinated has received a mixed response internationally. In countries like Chile and the United Kingdom, more than half the population have already received booster shots. On the other hand, countries like the United States, Brazil, and Russia have experienced fairly widespread reluctance to receive a booster shot. Only about 20% of the US population have received boosters, and in Russia, the number is below 5%. The World Bank estimates that global GDP grew by nearly 5.5% last year, but warns that economic growth is likely to slow down this year and next year. The US economy keeps roaring ahead, and inflation has now become a major headache. It is clear that inflation is not just a transitory phenomenon, and that COVID has actually resulted in a supply shock after the initial demand shock. Central banks are increasingly moving towards a more conservative monetary policy, and in America, overheating is a risk, whilst Chinese growth and inflation are both slowing. Pan-Europe, however, is enjoying a purple patch. When the COVID pandemic struck in early 2020, the effect it had on US unemployment seemed catastrophic. In the leisure and hospitality sector, for example, the light blue line, nearly half of all workers lost their jobs initially. Since then, the unemployment picture has improved substantially, and at current rates of growth, the US economy is approaching full employment. In other words, unemployment of no more than 3%. The two notable exceptions are the government sector, where many states are battling with fiscal problems, and the leisure and hospitality sector, where unemployment is still around 8%. The strong global economic recovery experienced during 2021, combined with a number of supply chain bottlenecks, had a strongly positive impact on most commodity prices. This is particularly true of soft commodities on the left-hand side and energy prices second from left. Precious metals like gold and platinum group metals were the only major category to experience a decline in prices during the year. For the month of December, however, all major categories experienced increases in prices. December was generally a good month on global equity markets. The MSCI World Index rose by 4.3% over the month. Europe returned 6.6%, while North America and the Pacific gained 4 and 2.4% respectively. For the fourth quarter, the MSCI World Index rose by an impressive 7.9%, but emerging markets lost 1.2%. For 2021 as a whole, the MSCI World Index returned 22.3% in dollar terms, but emerging markets were down 2.2%. This was largely due to China's precipitous decline of 18.6%. North America was the best performing continent, and the Europeans were in second place. There was considerable divergence in the performance of the various major equity indices during December. The JSE Top 40 stole the limelight with a return of 3.5% for the month, whilst the Hang Seng in Hong Kong declined by 4.6%. For the year as a whole, the Chinese mainland A50 index was the worst performing major index, whereas the CAC 40 in Paris was the top performer. Over 3 years, the Nasdaq remains firmly in first place, and the Hang Seng brings up the rear. Western equity markets have followed a similar trajectory over the past 5 years, but with notable differences in the performance of various major indices. For example, the Nasdaq, the light blue line, returned 281% for the period, whilst the S&P 500 rose by 213%. The Euro Stoxx 50 delivered a growth of 142%, whilst on the JSE, the all-share index rose by 126%. The FTSE 100 in London was by far the worst performer, with a total return of only 114% for the 5-year period. As was the case with equities, global commodity markets produced a mixed bag of results in December as well as for the year as a whole. Despite a drop in the oil price, coal and natural gas continued their upward trajectories, and natural gas was the best performing commodity for the month. Precious metals endured a torrid month and year, however, and platinum was December's worst performing commodity, while palladium was the year's worst performer. Gold also saw declines both in the month of December and for the year as a whole. For 2021, the undoubted best performing commodity was lithium, which saw an increase of nearly 324% in price. Due to a combination of inflation and supply chain disruptions, global GDP growth is likely to be more subdued in 2022. Compared to the estimated 5.9% for 2021, the IMF predicts GDP growth of 4.9% in 2022, and the World Bank an even more modest 4.1%. Inflation looks set to stay higher for longer, and global equities will probably have a tougher time of it in the coming year. As monetary policy tightens, market volatility is likely to increase, and this will necessitate a more cautious approach to investing. Higher inflation also means that real interest rates will remain low, and whilst the commodity boom seems to be over for now, a collapse is highly unlikely. After 4 years of hearings and a number of extensions, the Zondo Commission of Inquiry into State Capture finished its work in December, and the first section of the report on its findings has been handed over to the President. Among its most dramatic findings are that SARS was undermined deliberately, that South African Airways had been racked by corruption and fraud under Dudu Myeni, and that former President Zuma's foundation had benefited financially from a number of dodgy deals. Time will tell how vigorously those named in the report will be prosecuted, if at all. By New Year's Eve, nearly 3.5 million South Africans had tested positive for COVID-19, and more than 91,000 people had succumbed to the disease. The incidence of the Omicron variant was close to its peak, with Gauteng, KwaZulu-Natal and the Western Cape the provinces with the most active cases. To date, the Western Cape had suffered the greatest number of fatalities, followed by Gauteng and the Eastern Cape. Just under 28 million doses of vaccine had been administered, and 19 million people, or 32% of the population, had received at least one dose. 16 million people, or 27% of the population, are now deemed fully vaccinated. A combination of looting, load shedding and job losses saw South Africa's GDP decline by 1.5% in the third quarter, with the hardest hit sectors being retail, manufacturing and mining. Unemployment reached a new high in the third quarter, and Fitch has revised South Africa's credit rating outlook upwards. The National Assembly has failed to pass the controversial expropriation without compensation bill, and the petrol price has been rising steeply all year. Too much rain is now disrupting farming activity in many parts of the country, and sadly, a quarter of all South Africans suffer food insecurity, at the same time that nearly a third of the country's food goes to waste. According to Bloomberg, South Africa has the highest official unemployment rate on earth. According to the narrow official definition, 35% of working-age South Africans were unemployed in the third quarter, but if discouraged work seekers are included, the number rises to 47%. Namibia and Nigeria are the other countries with official rates above 30%, followed by Jordan at 25%. South Africa's share of the world's economic activity has been declining over recent decades. This is due to a combination of below-average GDP growth in rand terms and the depreciation of the rand against the US dollar. In 2012, our GDP represented 0.57% of global output, and by 2020 this had declined to a mere 0.27%. Despite expected improvements in 2021 and 2022, South Africa's contribution to the global aggregate will most likely be less than 0.25% this year. The JSE finished the year strongly, with the all-share index rising 4.6% in December. For the year as a whole, the all-share was up by 24%, and the three major sectoral indices were all more than 20% higher as well. The rand sadly depreciated against the stronger US dollar and lost 9.3% of its value against the greenback. Resources and rand hedge stocks benefited from the weaker rand, and bond yields followed global trends weaker. There is renewed concern over load shedding, and a court interdict has been issued against Shell's seismic survey on the Wild Coast. After the volatility and anxiety that characterized 2020, last year turned out to be a very good year for investors. In rand terms, local bonds produced a total return of nearly 8.5%, the all-share index more than 29%, the capped SWIX more than 27%, and local listed property nearly 37%. On the international front, in dollar terms, the MSCI World Index delivered a return of nearly 29% and global listed property over 37%. The two disappointing asset classes were global bonds, with a total return of only 3.5% in dollar terms, and domestic cash, with a total return of 3.8% in rand terms. Looking ahead, we expect this year to be a more challenging one for the global economy and investment markets. This is due to a number of factors, including tighter monetary policy, moderating global growth, and a diminishing trade surplus. Even though returns from equities are expected to be more muted this year, they should still come in well in advance of inflation and higher than those on bonds and cash. We are positioning our equity portfolios in a more defensive manner, with a focus on quality companies and fewer cyclical stocks. We expect non-resource rand hedges to outperform cyclicals, and we remain positive on bond yields, provided government makes it clear that it's serious about avoiding a debt trap. The current Adviceworx tactical asset allocation view can be summarized as follows. We see value in domestic equities and are looking to increase our exposure to this asset class by 1 to 2%. We retain our overweight position in domestic bonds and our underweight position in domestic cash. We also retain our underweight position regarding domestic property. On the international front, we are still positive about equities despite the stretched valuations, and we retain our maximum underweight position relative to global bonds. As far as international property is concerned, we remain positive on the asset class. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that the contents of this presentation will help you make sense of it all. Should you have any questions or queries, please feel free to contact me or your Adviceworx financial advisor. Until next time from me, goodbye.